Can you get me back to the slides? One question I see on the box, what about intraday strategy, seasonality, and also Canadian dollar, gas, and a few other markets? I'll be somewhat pessimistic. Intraday strategies I can't touch in this presentation, the entirely different ball game. Seasonality, again, is one of the reasons that I wrote the book on oil when I was thinking about including gas and agricultural. Seasonality, you have to incorporate it. The basic carry strategy doesn't work as well for seasonal. The only thing I would suggest, use 1 year carry. You cannot use, obviously, month 1, month 4, something that crosses the season, but it's not as powerful in seasonal commodities. Canadian dollar, though, I'm going to talk in a minute. That's actually somewhat interesting, and US dollar as well. So I'm going to talk about those in a minute. So this slide I'll probably skip. Again, this is more like for professional oil traders that trade in spreads. So basically, when you trade, I'll just say a couple of words here. When you trade a price directionally, you tend to favor signals like momentum and carry. However, as a professional oil traders, 90% of what we're doing are spreads. Because trading directionally is very tough unless you run a diversified portfolio of different assets. If you're focusing on one commodity, you want to eliminate this macro or other risk that you can't control. So we were trading mostly spreads like WTI versus Brent, heating oil versus crude oil, or time spreads, buying oil in one futures maturity, selling in the other. So spreads, unlike price, tend to mean revert. And the reason the spreads tend to mean revert, because the spreads generally represent the real option. Everything in the energy market is a real option on the spread. For example, an oil refinery, it's an option on the spread between gasoline and crude oil. So if this spread widens, then the refinery is going to start hedging it by selling the spread. And if the spread narrows, refinery reduces the runs and buys back the spread. Similar, the WTI Brent is essentially the spread on the ship. So the ship is a real option on transportation. So if Brent exceeds WTI by a lot, then you just buy WTI, put oil on the ship, and sell Brent. So which means the behavior of these real option owners contain the spread. The spread generally doesn't blow up too much unless there is a disruption like pipeline imploded or something like this. So you can construct like a little stat-art portfolio of these pairs on the spread, which kind of looks quite interesting. And there are other spread strategies that I have in the book, but again, I'll leave it for today's presentation.